Hello and welcome to Acclime's podcast series, Advancing Vietnam, with me, Vlad Savin, as your host. In this episode, I'm discussing with Matthew Lourey, Managing Partner at Acclime Vietnam, about the reporting and compliance framework for international investors operating in country, breaking down and explaining the key components and obligations within a calendar year. Matthew, welcome again to our new Advancing Vietnam podcast series. Happy to have you here and discuss this very specific topic, especially because tax finalizations are coming now within the 31st of March, and then we have the end of April PIT finalizations, and it's important for investors to understand their compliance needs.
Great to be here and happy to talk about it.
In Vietnam, the regulatory compliance requirements are complex, extensive, and paper-heavy. Investors are required to lodge a wide range of statutory, tax, labor, and investment reports with the Vietnamese authorities on a monthly, quarterly, and yearly basis. And where there is no oversight on these processes and specific deadlines, non-compliance risks often arise. A compliance calendar helps Vietnamese companies navigate these matters and plan for their accounting, taxation, payroll, statistical lodgements, and obligations. Let's start, Matthew, if you want, this discussion with explaining how would investors look at these requirements more from a general legal perspective and overview of how the system was designed so that we can better understand why these obligations are as they are now.
It's a very broad question. So just the starting point is that we have specific monthly, quarterly, annual obligations. There's a few ad hoc during the year, and the system is built around this constant reporting process. Some jurisdictions globally have a very similar reporting structure. Some have a very different sort of end of the year, do everything and don't have to do things during the year. So we do have a regulated framework, and as you say, it's paperwork heavy, it's compliance heavy. And a lot of these things are not value add. There's no add additional benefit for the company, but there is a regulatory requirement. So as you talk about that, the compliance calendar, understanding for your company what the specific requirements are, be it payroll, HR related, be it accounting, tax related, or connection between the two, or separately, as you say, there's statistical reports, there's other reports which come from that data set but go to different agencies. And really understanding what those are, and whether you are a monthly or a quarterly reporter, for example, for some of those taxes can be important, or what triggers that, and planning and understanding and not relating it back to your home country as a foreign investor is often the best way to start looking at that.
And one of the most used market entry structures for international investors is an enterprise, a standard LLC. Let's start first with understanding what are the compliance requirements for LLC, but initially after establishment in the first month after the company was established.
So your general requirements is you must register a tax code, you must register your stamp, that's usually done straight away, you register a tax code, you register for your VAT, you get your online token, and your online token is your electronic signature or electronic access to the government system, which is becoming far more digitized. You then register as an employer, you register for insurances, and you open a bank account. Now, all of those things fundamentally should be done in the first month. Employment things, maybe you can wait until you've got your first employees, but you need to do those within the first month. That triggers, because you've done that, you're in the systems. You've triggered the ongoing requirements. And the funny thing is, and had a discussion just with a new client just yesterday, that the fact that they have not done those or didn't do any trading doesn't remove the obligations to do those reporting, as I said, the monthly or quarterly reporting. It just means that when you do register, if you are late, you've got to go backwards and pay your penalties for not having done them. So it's not I'll wait and see and just, it's a holding company, I'll wait and see until I've got activities. It starts with, as you say, from within immediate after establishment, you have those obligations, they commence.
And within that first month, investors will need to purchase an accounting software that needs to be VAS compliant, and then make sure that they use that software for their local compliance and potentially convert it for their international.
Because you do have to pick a chart of accounts, which is a standard, but you've got to adopt a chart of accounts. You actually have to get your accounting system set up and ready to do those compliance obligations. Because, and we can talk about it in a moment, but the accounting specific obligations are quite bizarre when you think of it in a logical common law context. They're very practical from a Vietnamese perspective.
So looking at the VAS, we had as well a podcast just 1 or 2 months ago about IFRS and the new plan of the authorities for 2025. But focusing now on VAS, can you quickly explain to investors what does VAS mean from their point of view, and how should they use it within their compliance system?
So from a compliance, The compliance structure is in Vietnam from an accounting and tax perspective, you must follow Vietnamese accounting standards. It's a tax accounting system. It's a cash adjusted tax accounting system. It's your regulated, mandated process of what you need to do. And the accounting law ties the tax law, and they're very hard to separate in practice. So that means that you must maintain a Vietnamese compliant accounting system. You've got a fixed chart of accounts. You've got fixed mandatory reporting templates where you don't have the option to change a balance sheet and your profit and loss as a fixed format. And there is a required manner for entering journals. And you do need to have vouchers for journals signed off by your chief accountant, who you've appointed. As you said, you must appoint a chief accountant. And you must be doing this on a monthly basis and having that monthly. On inspection, they will go through each of the monthly accounting processes, your individual dossiers that form part of your journals, and make sure that that compliant. So it's not just your accounting software, it's the process for running that software. Mm-hmm. And we find one of the most frustrating thing to understand for a foreign investor is that they don't get to just journal as they want of their business. They have to follow a prescriptive process because Vietnamese accounting standards has a tax and accounting consequence. That leads to, from that data set, lodging your quarterly corporate income tax, provisional income tax, which is a month after the end of the quarter. Mm-hmm. And then, so you've got 4 of those. And then, so that gets you to the end of January. You've effectively paid your tax for the year. And then you do your finalisations at the end of March for that year's corporate income tax. Mm-hmm. Because that accounting software, the accounting records, forms part of your income tax process.
Mm-hmm. And speaking of tax, that's obviously one of the most tedious compliance requirements and complex requirements for international investors. And the reporting focuses in a big bulk within the tax reporting for companies in Vietnam. And we have the corporate income tax, as you mentioned. We have the VAT. We have as well the foreign contractor withholding tax that is often quite important, but missed out by a lot of investors because of the specifics on how it works, and as well the personal income tax. Can we, for the next few minutes, break this down into what they are and how the reporting works for each of those?
Let's start with the VAT. So VAT, value-added tax, sometimes called a GST in some countries, is a tax paid essentially by the end consumer. It flows through the process, but it is a tax. So it's 10% in Vietnam levied on top of the value of the goods. That 10% value is withheld, and any inputs you have for other costs, you get to offset that. The net amount of VAT you must remit every quarter if you're a small taxpayer. If you're a large taxpayer, you must report and remit every month. Mm-hmm. So there's small and large taxpayers in that context. Your VAT reporting is based upon tax invoices. If you don't have a tax invoice, the old commonly called red receipt, you cannot claim the VAT back. And if you don't, but that doesn't stop you. If you haven't issued a VAT invoice, you are still liable for the VAT. So VAT invoice is important. And by the way, without those VAT invoices, you can't claim your corporate income tax. We'll touch in a moment. So it's the start of the system is that you must have your VAT invoices, and that generates your VAT liability. The next part is your corporate income tax. So corporate income tax is a tax on the profit of the company. So 20% is the standard rate. There's some variations and some benefits and higher rates, but 20% is by far and wide the standard rate. And 20% of your profit at the end of the day, subject to adjustments, will be subject to 20% corporate income tax. You pay the provisional amount each quarter based upon your VAS accounting records on a quarterly basis. So for your March quarter, you'll pay that in the end of April. And you pay that based upon your estimated, and then you do your finalisation at the end of the year. And so that process of quarterly corporate income tax payments based on assumed profits as you go, based on your accounting system, your monthly or quarterly VAT, which is the transactional tax effectively as we go, and they're the two main main tax that apply to a company on an ongoing basis. With foreign contractor withholding tax is on a per transaction basis. So if I pay a service provider offshore, I'm required to withhold, and that's royalties, that's service payments, that's consulting fees, and remit. There is some the law isn't completely clear anymore. It was, and it's made a bit murkier, but effectively it's 10 days from the date of the transaction or the date the payment was due, not necessarily when you make the payment, but within a 10-day period, you must have remitted that foreign contractor's tax. And again, as a standard rate, that's generally 10% being done. It varies and there's different calculations, but that's another tax that you need to be aware of.
Mm-hmm. And what about the personal income tax?
So let's look at payroll then. So payroll and HR. Personal income tax is a tax on the individuals. It's an employee tax. It's not the corporate, it's not the employer's responsibility. So, but the employer is responsible to calculate and withhold that tax from the employee's salary. So the gross salary, withhold personal income tax and send that to the tax office. Now that is remitted monthly or quarterly, depending if you're small or large. It's the same as the VAT test. So if you're large for VAT, you're large for PIT. If you're small for VAT, you're small for PIT. So that test of monthly or quarterly comes down to, so you're withholding it based upon a 0 to 35% tax rate based on their own circumstances, and each individual that can vary if they've got dependents, etc. So there's a scale and a register and process. In addition, you are to withhold insurances. So there's 3 insurances in payroll: social insurance, health insurance, unemployment, and that is pension, that is workers' compensation, that's sick leave, maternity leave, is a range of things which are common in some countries not so common, but they are withheld and the employer has to pay a portion as well. So depending on the salary, it can be as high as 21.5%. The employer has to contribute. Employee contributes, say, 10.5%. Again, that can vary. And with all of that, you've got to do the insurances every month at the month end, the personal income tax, the month after or the quarter after, and you are remitting. So we've now got a combination of VAT, CIT, foreign contractor withholding tax, personal income tax, social health and unemployment insurances, and you've got your trade union fees that you also on your payroll. So some are company obligations, some are company withholdings and remittance obligations. So there's quite a few coming through there just on the tax and the remittances to the authorities. So that's where, to come back to your calendar comment, you need to build those into the calendar. This context of compliance calendar you mentioned is something that is not built into law. It's something that we encourage companies to have, because without that, you start losing track of, are we compliant? Are we meeting obligations? Are we late with these activities?
And you mentioned before that within each quarter, investors need to estimate their provisional CIT, and at the end of the year, it will be finalization. What happens if by the end of the year, they miss out that 80% estimate threshold that they need to meet when they have the final calculation of their CIT?
There's an additional taxes paid. There's additional interest for late payment and penalty. So the law requires you to have paid, by the time you do your 4th payment, you need to have made sure you've paid sufficient amount. You can't just pay small drips and then when you do your tax finalisation, here's the rest of it. They want that the onus is on companies to maintain an accounting system that allows them to estimate accurately their taxes. So you can't do it's March, I'm finalising taxes, I'll just do some tax adjustments now and clear it all up. One, your VAT invoices won't match. And again, without VAT invoices, you can't have deductions. So by January, you will know what invoices you've issued and received. You'll know your accounting records far away. Now, you might have some adjustments back and forth and non-deductibles, etc., or additional income that's accessible that was not subject to VAT on timing, but relatively minor in a transaction across the whole year. So the law is designed around, if you haven't paid sufficient tax by the end of quarter 4, you're probably not doing your accounting properly anyway, hence the linkage between accounting and tax.
Right. And what about looking at dividends? Obviously, investors are in country here to generate profits and then repatriate those dividends on the ongoing basis. How does the compliance for dividend repatriation works?
So you are permitted to repatriate as foreign investor, 1 dividend per year. And after tax finalisation, and once you finalise tax, you can remit a dividend from those profits. The keys are you must have had a profit the most recent tax year, and the second thing is that you must have retained profits to distribute. So you must meet both those conditions. You must have retained profits, and the most recent year is a profit year. If you meet those criteria, you can declare a dividend up to the maximum amount of your retained profits. And you could declare and notify your bank and tax authorities. The tax authorities have 7 days to object, to say basically you have not met your tax, you're not up to date with your tax obligations. If the tax office doesn't object, the bank can remit the payments to the foreign shareholders' account. Now, if you haven't met your obligations, if you have penalties for late payment, if you're under audit, the tax authorities can reject and object to your dividend and say you are not fully compliant and therefore you're not permitted to remit your dividend. So planning on your dividend, again, putting on the calendar, if you've got an annual dividend that you're going to remit, put it in the calendar, understand that, make sure that you've got your obligations met leading up to that. Otherwise, you may not be able to remit your dividend out of country.
Mm-hmm. One of the compliance requirements that is often problematic for international investors is the investment reports, the statistical reports. There are just so many of them. And each year, it seems that the authorities are putting in place a new report, a new statistic that they want to figure out from the investors. Can you explain a bit why these reports exist and why they're so tedious? I think there's at least 5 or 6 for investors from the statutory investment perspective, and then we have labor reports, which we can talk in a separate discussion.
Well, let's put all the reports together. Yeah. So there is a significant number of reports to the authorities as an investor that are being issued that, again, have no benefit or appear to have no benefit to the investor. So they're not being done for the company's benefit. And once you get past that, there is no benefit to me. These are obligations for the authorities because Vietnamese authorities work in silos and we don't interconnect very well, and they want for their own purposes, they want to make sure they have the right data sets and the right information they're working with. For example, the labour reports, I'll start with those. You've got accident reports, you've got use of foreign labour reports, you've got general reports, sort of half-yearly and yearly reports that are going through, and they're to meet certain requirements of how things are going, what's happening, and measuring different employees and understanding where they need resources. You can sort of understand when you start going through, as tedious as they are. You've got other reports then come through, such as state bank reports. If you've got foreign loans, you've got to report about how those loans. If you've got certain business sectors, certain coming in, you may need to report on those. So trying to understand is, if approvals are given, how are those approvals being met? What's happening in society? Where's the money going? What activities? You've got your DPI reports, your general statistical reports, which are monthly activity-based reports to understand where things are in the economy and how the investment approvals for certain sectors flow. Trying to understand where the money is, where the government should be putting focus, what's working, what's not working. And it is trying to capture data. Now, arguably, is there better ways to do it? Absolutely. Could there be systems built to track that data that is already probably in the system anyway, from tax lodgements and other lodgements? Absolutely. But it's not. And this is that point at the start. It's not necessarily a logic test based on common law logic. It is the way the systems are. So if you get past that and go, we just have to do it, there is a purpose. The authorities aren't doing it to make our life difficult. They are using that information. They need it as part of their planning and process. So you may, depending upon your sector and what you're doing, end up with 15 or 16 different reports over a year, some quarterly, some half yearly, some annual, some monthly, that you are trying to lodge, that have no benefit but are required. If you don't, some of them have minimal penalties. Some of them might just, later on, you have to go back and redo them. Some of them can have significant penalties and have impact on your business and restrictions on your business if you do not lodge them.
And that's where difference appear when we discuss with investors that they are used with, for example, a corporate secretarial Singapore style, where they have end of the year annual report with everything done. And
tax lodgements, get it all done at one time.
And when they ask us about how does it work in Vietnam, when is the report date and what's happening, where we tell them that they have monthly, quarterly, half-yearly and yearly reports on various angles, up to 11 or 12, that's when misunderstandings of the concept of the law and the framework for investors and how it works.
So that, back to your first concept, the compliance calendar, the first thing we do when we start working with a new client is this kickoff meeting, understanding their needs, when do they need reports, what their internal needs are, but also what are the statutory obligations. We're trying to build this compliance calendar for all these key dates, statistical reports, all the dealing with the HR requirements. And so if we've got a 25th of the month releasing salary date, when do we need to do things to the client? What does that trigger for the reporting? When do things have to go to the authorities? What is that resource planning required from the client side, our side? And if a client is doing it internally, that same approach should be that calendar of all key dates. The governance often sits with the chief accountant in Vietnam, but the chief accountant may not have oversight of the payroll. So you can't just rely on that alone. You don't have a company secretary in Vietnam. You don't have the general governance officer roles. So now we recommend that if your chief accountant is not involved with the full scope of compliance, you have a compliance officer. You actually have someone, could be the general director, but someone who is in charge of that calendar and is responsible for making sure whenever the changes of laws or whenever the changes of thresholds from a small taxpayer to a large taxpayer, quarterly to monthly, that's built into the calendar, and that calendar is constantly updated and on track to ensure that it meets compliance in country and the investors' needs as well, because it does a dual function.
Mm-hmm. And are there any transfer pricing requirements that are ongoing for international investors in Vietnam, and what they are and how do they apply for this case?
Transfer pricing break into two ways. One is you've got an obligation for reporting your Form 1 and associated documents in your tax, which is related party. You're reporting related party transactions and parties. So you are doing that on a regular basis as part of your tax lodgement. So the end of March every year, you've got to do that. You've then got your transfer pricing if you meet the thresholds, where you may have to do a country by country report, and you may have to do a master report and country report. And you must have them ready for each year. You don't have to lodge them specifically, but you must have them available so that when they inspect, but you've got to report that you have them available. So you've got to report that you've done these things, and then you've got 30 days, potentially 45 days, but 30 days from announcement, they're going to inspect that, they're going to see these reports that you have done annually and form part of your annual compliance. And again, there are thresholds, and I think we've done other podcasts on the topic, but the thresholds are also important of maintaining and watching your calendar, but also where you are monthly, quarterly, thresholds for transfer pricing, so that if you trigger something, you're on top of that and it's in your calendar. Make sure that you've got your transfer pricing documentation. And on that 30 days, it's virtually impossible to do a proper set of translated Vietnamese transfer pricing documentation that would work for your group purposes as well within that 30-day period. Can be done, but I would never rely upon this idea of we'll do it when we get notified for inspection. It needs to be part of your calendar and your regular process.
Mm-hmm. And looking at calendars and processes, IFRS is planned to be implemented within after 2025, moving forwards for the majority of investors in Vietnam. How would this change the current compliance calendar and the current compliance regulations and obligations when we look at this transition towards IFRS?
Effectively, it won't change anything. It may change the method of doing journals. Mm-hmm. It may change the reporting templates. It may change. But keep in mind, the vast majority will get Vietnamese adjusted IFRS. Mm-hmm. So VFRS will be the norm. And that VFRS, we're still waiting on the final forms and how it's going to be. But from a tax perspective, we're not going to see significant change from our obligations. And from an accounting point of view, it'll be a transition to obligations, but there'll still be obligations that will exist. Mm-hmm. They may be more optional. They may be less prescriptive, but ultimately, based on how the Vietnamese structure exists, we're not going to see significant change. Mm-hmm. So it may be benefit where our accounting results are aligned Vietnamese and globally, but that's not to change obligations. Mm-hmm. And just to sort of one of the reasons, and just to sort of listeners that why we have these differences is Vietnam has no common law structure. We have no reference, even though we're more aligning with our legislation each year to be international best practice. There's an alignment process. We have a French-based civil law system. We have a socialist communist sort of layer sitting above that about how society works and expectations. And we have a Soviet-inspired Eastern European enterprise law sort of that was put in place in the late 80s. That is the foundation. So you've got systems there that do not align easily with common law expectations. So that's why as Vietnam develops, there is more alignment, but the historical basis does not make sort of that easy transition from a common law concept, international business practice to Vietnam. There is going to be sort of round peg, square holes that we're trying to solve, and the authorities move, but there is that reluctance, resistance in some ways based on history to just do a sweeping changes, and we have to accept that as foreign investors in Vietnam.
Mm-hmm. Matthew, thank you again for your time and these practical insights for international investors.
Thank you very much. Always great to talk, Vlad.
We encourage all foreign invested businesses in Vietnam to maintain and peruse updated compliance calendar for their current year to ensure they understand and track all their compliance obligations and are able to minimize any potential risks that may affect their business plan in the country. If you don't know where to start, feel free to download our 2023 compliance guide for Vietnam from our website, vietnam.acclime.com, and reach out to us if you need any support with your planning. Thank you. And many thanks to you, our listeners, for tuning in to Advancing Vietnam podcast series. For more information about this topic, please check out our publications on vietnam.acclime.com. And if you want to reach out to us for any additional details, feel free to contact me on LinkedIn or throughout the website contact details.